But to kick off with, before we get on to the investments presentations, I'm going to give you a quick run through some pensions tax issues. So that's just a reminder of those risk ones if you didn't get enough of them in the first 5 minutes there. So the things I'm going to run through briefly as we get into a new tax year. So look at pension tax relief and some of the very basics of how pension tax relief works. We'll then look at ways to boost the amount that you can pay into your pension each year, how to avoid having your annual allowance reduced dramatically when you access your pension using the pension freedoms, and finally avoiding what is quite a penal tax trap from HMRC when you access your pension for the first time. So we'll kick off with pension tax relief, and I appreciate a lot of people in the audience here will be experienced investors and you'll know exactly how all of this works, but I make no apology for explaining just the sheer value of saving into a pension, both through tax relief and through the matched employer contribution that you get through automatic enrolment as well. I think that the pensions industry historically has actually been very bad at explaining the quite simple value that a pension brings to people, and I think the government's probably got some questions to answer there in terms of making it quite complicated, particularly at the top end, for people to save for retirement. So the basics of pensions tax relief, we're going to look at two bits, so relief at source and net pay. So those are the different ways that you can receive tax relief. And as we're in Scotland, I'll make sure to cover the different tax reliefs you get up here following the announcements in the December budget by Mr. Mackay. So relief at source, you pay in £80, you automatically get £100 in your pension through basic rate tax relief. You can then claim back an extra 20 quid if you're a high rate taxpayer, or an extra 25 quid if you're an additional rate taxpayer. So it can cost you 55 quid to get 100 quid in your SIP. That's a pretty amazing deal, and I think historically we as the industry have not been very good at explaining those quite simple ways that can work. As I mentioned, works slightly differently in Scotland, and I'll go into that in a moment. The other way that you can get pension tax relief is through what's called a net pay arrangement. So on paper, this looks simpler than a relief at source system. So your pension contribution is just taken automatically from your gross pay, and you get the tax relief that you're due automatically as a result of it coming from your pre-tax pay. Now that sounds all well and good, and it's up to pension schemes how they want to provide tax relief. The issue, as you can see at the bottom there, with net pay schemes is that the very lowest earners tend to be the ones that miss out as a result of having a net pay system. This is a particular problem with automatic enrolment. So if anybody who's earning £10,000 or more will be automatically enrolled into a pension. Of course, anyone who's earning £12,500 or more will pay tax. So if you're in a net pay scheme and you're earning above £10,000 but less than £12,500, you won't automatically get the tax relief that you're owed. Now that's a particularly cruel one actually, because obviously, you're hurting the lowest earning in society who need that top up perhaps more than anyone else. But this also tends to be more likely to be part-time workers as well, and tends to more likely as well, part-time workers more often than not tend to be women as well, who at the moment have on average lower pension provision as well. So it's a real kicking that these people get when they're already potentially in a difficult retirement position. There's a lot of lobbying going on around that to try and amend that issue, but at the moment that is how it works. Not ideal, but that's how the system works. Now, as I mentioned earlier, as I'm sure everybody here is aware, the income tax system in Scotland now works differently to the rest of the UK, and I've just set that out in the table here. So in the rest of the UK, you've got personal allowance, basic rate tax band, higher rate and additional rate tax is paid. In Scotland, we've got a starter rate now. We've got a Scottish basic rate, a slightly different band there, an intermediate rate and different level, a slightly higher rate and top rate of tax. Now, when this was introduced, the Scottish government said that the argument for it was to make the highest earning pay a bit more, and that anyone earning less than £33,000 wouldn't pay any more income tax as a result. Now, regardless of the politics of that decision, it does have an impact on the amount of pension tax relief different people can get. So if we go back to the first example, looking at a relief at source scheme, so this is where the tax relief is claimed on your behalf by the pension scheme. So if you're in a SIP, for example, this is how you'll get your tax relief. So £80 in, again, it gets turned into £100 automatically. Different amounts then that you can claim back through your tax return. So £1 extra if you're an intermediate rate taxpayer. I think there's question marks about how many people north of the border will bother to go through the process of filling out a tax return in order to get an extra 1 percentage point of tax relief. We'll probably find that out in the coming months when we get that data. £21 for a higher rate taxpayer and £26 for an additional rate taxpayer. So just an extra reason if you're a taxpayer in Scotland potentially to save into a pension, particularly if you're a higher earner, higher rate taxpayer or an additional rate taxpayer, because it's just a little bit more attractive as a result of those tax changes. Just to round things off, the net pay system, exactly the same as on the previous side. So because your contribution is taken automatically out of your gross pay, you don't need to worry about filling out tax returns and things because you already get the marginal rate of tax relief automatically. But that same issue exists, as I mentioned earlier, for lower earners, particularly as a result of automatic enrolment. Now, I know I said at the start that pensions and the way that the industry has explained tax relief to people has been quite poor, and I think part of the reason for that is that actually there's quite a lot of complexity in the system. So you've now got 3 different annual allowances that you need to navigate, which we're going to get onto. There's a lifetime allowance, which has been changed over the years, but there's also some handy things that have been introduced as a result of those dramatic cuts in the annual allowance that we've seen since 2009-10, when it was £255,000, now down to £40,000, which can be useful if you're planning your financial affairs. And one of those is carry forward. So I'm not sure if everyone will be able to see on this slide, but I believe the slides will be available afterwards for anyone who's got eyesight as bad as mine is. But the way that carry forward works is that if you haven't used up your annual allowance in the 3 previous tax years, so the 3 tax years that are directly before the one that you're saving in at the moment, then you may be able to go back and use that annual allowance in the current tax year and increase the amount that you can save into a pension tax-free. So used to its maximum, you can save 160 grand in a pension in the current tax year by going back and dipping into the 3 previous tax years where you haven't used any annual allowance. With something like that, I always think an example works better, and I thought nobody better to show us how to save into a pension, Mr. David Brent, one of my all-time heroes. So David, age 58, was recently made redundant from his job managing a sub-branch paper merchant. He spent a chunk of his severance package releasing his debut single, as you would expect him to. However, he's got £148,000 left spare and wants to use it to make up for years of living too fast by putting it into his SIP. He paid into a pension 10 years ago, so he's eligible for carry forward, but hasn't made any recent payments. As a result of his current position, David is able to make use of carry forward to its full extent. So he can pay in to the current tax year, £40,000, including tax relief. He can then dip into those 3 previous tax years, take all the money forward, and he can pay in a total of £160,000 into his pension without paying any tax. Now, that is a fairly quick, glossed over explanation of how carry forward works. I'd suggest if you're considering taking advantage of that, speak to a financial advisor to make sure you understand the rules and how they'll impact on your own personal circumstances. But a few things to note. So as I've mentioned, you can only carry forward from the previous 3 tax years' annual allowances, so not from tax years before that. Those affected by the annual allowance taper, which is one of the most horrible parts of the current pension tax regime. So anyone earning above £150,000 can have their annual allowance reduced to somewhere between £40,000 and £10,000, and quite often they don't actually know exactly how low it's going to be reduced to, so it makes it very difficult to plan. But if you're affected by the taper, then you're only able to carry forward up to the level of the taper, depending on what your allowance was in that tax year. And finally, and we'll get onto this in a subsequent slide, if you've accessed any taxable income from your pension using the pension freedoms, then your ability to use carry forward ceases. So we've looked at one way to improve the amount that you can pay into a pension. Now we're going to look at a way to make sure that you don't drastically reduce the amount that you can save into a pension in a tax incentivized environment. So as I touched on earlier, bit of a mess of allowances that exist, particularly for those who are higher earners or paying more into a pension. So the amount that you can pay into a pension each year will depend on how much you're earning and what you've done, but there are 3 principal annual allowances: the tapered annual allowance, which I mentioned, the overall annual allowance, which affects most people, and the money purchase annual allowance. Now, again, as with previously, I thought going through a worked example would be the best way to show just how a simple way of accessing your your pension money, and actually using the pension freedoms in a way that the government has essentially encouraged people to do, can lead to some quite negative savings outcomes. So David, now 59, has decided to release his debut album, thinks it's only going to cost him £45,000 to cover all of the costs of his UK tour. His pension's worth £175,000, and he's trying to think about the implications of taking the full £45,000 from his pension, so what impact that's going to have on his ability to save in older age. He's now a basic rate taxpayer, so what will the impact be of him taking that £45,000? Well, as I'm sure you've guessed, quite a significant impact. So he's got £175,000 in his SIP initially, takes the tax-free cash, very sensible move, doesn't quite come up to the amount of money that he needs to pay for his UK-wide tour. So he takes an extra £1,562.50 from his pension, tax comes off that, and he's got enough money, £45,000, to pay for all the costs that he needs to pay for. But the impact of that is significant. So he's triggered the money purchase annual allowance just by taking that relatively small amount of taxable income from his pension. The MPAA has kicked in. As a result, his annual allowance for the current tax year down from £40,000 to just £4,000. So an incredibly penal change to the amount of money that you can save in any given tax year. Also lost the ability to carry forward unused allowances from the previous tax year. So quite a simple example there, but a key lesson and a key mistake that lots of people make. When you get to age 55, you've got the pension freedoms in place, very attractive, huge flexibilities. And sometimes people think, I just want to get at that money whenever I can for whatever reason, if I've got a particular thing to spend on. But the impact of getting at that money, as you can see here, is absolutely enormous. And anyone who's thinking of taking taxable income from their pension from age 55 needs to think very, very carefully about the knock-on impact that's going to have on your ability to top up your savings after taking that withdrawal. Now, the final thing I'm going to talk about, another cheery one for you here, HMRC's pension freedoms tax trap. So I'm sure most of you will remember back in March 2014 when George Osborne announced the pension freedoms. It was a huge shock announcement 4 years ago now. I can't believe it's that long ago. There was no consultation on how that announcement was going to work, and I think frankly there was very little thinking went into exactly how to make those new reforms, which are utterly radical, how to make those reforms work on a practical level. So there was a cabal of a few people who knew about these reforms happening. As a result, you didn't have all the brains in HMRC involved, all the people in the industry who would normally be involved to make sure that any issues with the freedoms can be ironed out. As a result, we have the problem of people taking single withdrawals from their pension flexibly in a given tax year. Now, HMRC is set up to deal with regular streams of income. That's what they've been used to over their entire history. So the pension freedoms drive a coach and horses through that system because, as you know, people can take money as and when they want from their pension, including taking a single withdrawal in a tax year. And that gives HMRC a problem of trying to work out how to treat that single withdrawal where there's no other income in place. And what HMRC has decided to do, and this has been the case since the pension freedoms were announced, has never been consulted on publicly, has never been talked about publicly other in the financial press, was to apply what's known as a month one or emergency tax code to those single pension freedoms withdrawals. So what that means on a practical level is that rather than getting all the allowances that you would expect in the tax year, you'll have all those allowances divided by 12 and then applied to whatever money you take out on that single withdrawal. Now, if you make multiple withdrawals, then HMRC should put those withdrawals in the right tax position because it will be able to apply the correct tax code. But the issue is that lots and lots of people, quite sensibly, have been told that they can access their pensions how they want, and they might be trying to manage their withdrawals in a way that minimises the amount of tax they pay, but actually in the short term, you can end up paying a huge amount of tax. And again, we'll have one final example to work through exactly how that can impact on people. So David's now 62, wants one last shot at fame, and is ready to release his difficult second album. It's not going to be difficult for him, it's going to be fine. And he reckons he's only going to need £10,000 to pay for all the distribution, the recording, the promotion, and all the rest of it. We saw earlier, he's already used up his tax-free cash entitlement, but because his withdrawals below the personal allowance, he's not working anymore, so he's not got any other taxable earnings. He thinks that he's going to be able to take the whole £10,000 withdrawal tax-free, but as you've probably guessed, he is incorrect. So when he takes out the £10,000 withdrawal, month one tax code kicks in. That means that rather than having a £12,500 annual personal allowance, that's reduced to just £1,042 tax-free. So the next £3,125, so that's the basic rate band divided by 12, that's taxed at 20%, and the rest of his withdrawals, over half of it, £5,833, is taxed at the higher rate band of 40%. So the net impact of this, and I should say that AJ Bell has two specific parts of its business. It's got the You Invest part of the business, which is the direct-to-consumer part, and then it's got an Invest Centre side of the business, which deals with independent financial advisors. Now, we get more questions from financial advisors, more queries and more complaints about this issue than any other issue. It catches so many people out, even to this day. The result of all that tax being applied is that rather than paying zero tax, as he quite reasonably thought he would pay, he's paid almost £3,000 on that money. Now, we've been part of quite a concerted campaign to try to get HMRC to change the way that it applies this tax. We think it's incredibly unfair. We think there's a risk that particularly people who take the money out for specific reasons. So if you've got an elderly relative who's going into a care home and you want to take £10,000 out to pay for their fees, and you understandably, like in this example here, think that that's going to be a tax-free withdrawal because you've not got any other income. If you get another £3,000 less as a result of the way HMRC has applied that tax, that could be a significant blow to you. And a lot of people just have no idea how this stuff works, absolutely no idea. So they wouldn't know the processes they've got to go through in order to get the money back. Luckily, there are processes that you can go through to get the money back. It's more complicated than ideally would be the case, given that a lot of people will be who are using the pension freedoms in this way may never have filled out a tax return in their life. But nonetheless, there are 3 different forms which you should be familiar with. If you take a single withdrawal, which can mean that you can get back the tax that you are owed. So they're all rather nattily named. The P55, which is obviously a familiar one. We've then got the new ones, the P53Z and the P50Z. So one of those 3 forms, depending on how you've taken out the money, will be the right one to fill in order to get your tax back. And if you fill out the right one, HMRC has told us several times you'll get the money back in 30 days. If you don't fill out the right form, then you're leaving yourself in the position where you're relying on the efficiency of Her Majesty's Revenue and Customs to make sure you pay the right amount of tax. Now, I don't know about you, but I think I'd rather rely on myself than HMRC to make sure I'm paying the right amount of tax on my pension freedoms withdrawals. So that's just one to look out for. Thank you very much. That's all from me.